Welcome back to the Scholar Wealth Podcast. This week, a question about buying a new home before selling the old one and how to weigh the trade-off between selling investments for cash versus taking on some short-term debt. Then we look at the growing trend of private market options showing up in 401k plans and what investors should consider before adding them to their retirement portfolios. And finally, a conversation with Julie Baird, president of First American Exchange Company, one of the nation's leading qualified intermediaries helping clients across the country navigate 1031 tax-deferred exchanges. Julie shares what investors should know about timelines, replacement property rules, and how these exchanges fit into the long-term wealth and estate planning. So let's go ahead and get started with question number one.
We are moving and have not yet sold our current home. As we look to purchase our new home, we can either get a mortgage or sell investments from our brokerage account to buy the new home for cash. Then when the current home sells, replace the funds in the brokerage account. There is an opportunity cost with removing the funds from the market, but there is also cost to setting up a loan and paying it off in a short-term horizon. How should we analyze this decision?
For this type of situation, we have to weigh out whether selling versus the mortgage takes into account both the flexibility that you have at that time, but also the reality of selling the home. I'd say that's probably the biggest factor that comes into these decisions. When I'm speaking to somebody and we're walking through this exact scenario, one of the first questions that comes up is, first, can you maintain both homes? So that's rule number one. Is this a moot point of you're not going to be able to have both of them going on? If you can from this, because the first home is paid off, sounds like you would be able to. You just have one mortgage to deal with on maintaining the two homes. The next comes in, how fast do you think you're going to sell the home? Now, this one you have to be a little careful on because a lot of people think that their home is going to sell quickly, and then they find out that it might not sell as quickly as they hoped or not sell as quickly as they hoped for the amount that they were hoping to get from it. So we want to be careful on any type of math that we're doing or any type of modeling that you're doing on this type of situation. Is it actually accurate, and does it have some buffer room in there for if the house doesn't sell for 6 months, is that still doable, both in an ongoing cash flow perspective from the mortgage and just an overall sales perspective of the value you expect to get for your current home? So assuming that's good, then we get into this all works. I want to buy the house. I'm ready to buy the house. Does the money come from the brokerage account or does it come from a mortgage? This one's relatively easy, especially if it's straightforward in the sense of if you can go into your investment account and pull out the money you need to be able to purchase the home in cash for a minimal amount of capital gains. Now, I know that's minimal is a tough word to use because it's relative, but in times where the market's dropping or you have recent additions into a portfolio, a lot of people are surprised that they could probably free up that amount of cash for 3 or 4% of the total amount of the portfolio they're pulling if they do so strategically. So if you're pulling $1 million out of the account and you have $200,000 worth of gains and you're going to go pay 15% on that, or $30,000 to free up $1 million at 3% is probably worth it, especially when you compare to cost of a mortgage or anything along those lines. And a lot of times it comes down to the ease of not having to deal with a mortgage and just paying for it in cash. Now, let's say you look at it and say, that's not the case. I've got some huge gains in here. I have problems. I'm not going to be able to free up that much cash that easily. So in that scenario, we start looking at short-term cash. So this is one of the few times where you could tap into an emergency reserve. If you have 6 months, a year worth of cash, or a couple years of cash, maybe pulling a large amount of that could be useful along with something like a bridge loan, or you start getting into lines of credit. So you have a couple options when it goes to the lines of credit route. You can go a portfolio line of credit if your broker allows it. These typically have higher interest rates. You have to be a little careful there of how long you're going to keep that line of credit. Going back to that initial concept of how long is it going to take for you to sell your house? If you said, well, I'm not going to go pay the $30,000 in capital gains, but I'm going to go take out a portfolio line of credit for $1 million. And now I'm going to pay 7 or 8% on it. And I'm not going to be able to sell my house for 6 months. Well, you already paid your $30,000. You should have just gone and sold the cash out of the portfolio and gone that direction, especially with the market where it is. Whenever we're looking at overall valuations and cash deployment, we have to look at valuations on the market now versus what the expected returns would be in the future. If valuations in the market are higher, then we can't use the average return as an expectation of the future. If valuations are lower, then we'd probably use something a little higher. So I'd say that opportunity cost that you're bringing up of selling investments that opportunity cost is lower the higher the valuations are on the market, which I'd argue is where we are right now from a historical context. Your other option is always a home equity line, depending on what your current home value is. Since it sounds like it's paid off, going in and pulling out a large home equity line of credit on the current home and use that in combination with some short-term cash and maybe selling off some of the securities that have the lowest amount of capital gains could give you this combination of cash and liquidity that you need to go buy the home in cash. And then when you sell your current home, you pay off the equity line at that time. So still have to watch the interest rates there. But what it really boils down to is we want to be able to stay flexible, but not overthink the tax and opportunity cost situations of selling brokerage holdings to free up that cash, because a lot of times those tend to be overstated. Let's go into our second question.
I've heard that my 401k will be offering some new private market investment options. How can I tell if they're worth considering?
We have to be careful when we're investing in any type of private investments. And it's not to say that private investments are a bad idea or that they're unnecessarily risky. It's a different type of risk and a different type of transparency that's required of these private investments. Now, what's made that really interesting over the past few months is that with the executive order in August, we've now allowed, or at least in theory, allowed private investments into 401k plans, or allowing private investments to be included as an option for 401k plan participants. There's still some limitations on that yet as we wait guidance from the SEC and Department of Labor on what that's going to look like in protection, because you have to think, if you're a 401k provider and you're adding that list of all of those different funds, you have to assess things like, is the risk appropriate? Is the fee appropriate? Or all these different things? Does it make sense for it to be included in a list of potential funds for plan participants to choose to put their 401k in, to put their retirement savings? Because of the issues of private equity, there's been a pause there of some of these sponsors saying, I'm not ready to jump in yet and say all the employees of this company can have access to this private equity fund, because they don't really know what protections they have as a fiduciary in those scenarios. So it's still not there yet. When we start looking at why we include them or should you participate in them, I'd be pretty cautious upfront. The reason for that is typically we'd recommend no more than like maybe 10, 15% in private investments. And that's after you've hit some pretty major milestones in your finances. In other words, we want to make sure you have adequate liquidity, you're being an accredited investor, you have plenty of wealth to get you to retirement. So now we're talking about a portfolio that's truly building up, not a base level of retirement savings, but an excess amount of discretionary capital for you to use. So we start jumping into the private markets. The problem with the 401k is that by definition, the 401k participants are everyone. So traditionally, private market investments are only allowed to be given to accredited investors. So you have to meet a certain net worth threshold or income threshold before you're allowed to participate in these markets. The reason for that is because of the lack of transparency and the opaqueness of private investments. That leads itself to a lot of potential for risk, both in straight counterparty risk and the risks of the actual investments. The government then set a accredited investor line, said, if you have a certain level of net worth, maybe we don't have to worry about you as much, or you're going to be classified as a sophisticated investor, so maybe you don't fall prey to some of these traps. Now, I'd argue that I don't think net worth is a good measure of necessarily investor sophistication. There's no test that gets taken for anyone to say you're allowed to invest in highly complex instruments. We just use an arbitrary number of net worth or income and say, well, if you meet this, then you're allowed to invest in a lot of things that have a lot of complexity built in. The problem I have with this, and the worry that I have, is how private investments are actually priced and the lack of them being marked to market. So being marked to market would say that if I pull up the price of Apple right now, I can get you that price. I can tell you exactly what it's trading at right now in the market. The problem with private equity is similar to your home. Think of your home value and saying, is my home marked to market? It's not. No one's trading your home on a daily basis. So you can have an idea of how much your home is worth, but you really don't know until it sells. So private equity is even more opaque in that there's no Zillow out there that tells you how much your private equity is worth. So when you get a private equity position, now you have a situation where you may buy into something in your 401k. Let's say you go through $100,000 in 401k into this one private equity position. How do we deal with situations like returns that are delayed or value that gets placed on your quarterly 401k statement? Do we just put a NA on there for not applicable? We don't know, or a question mark on the value component. It's really hard to verify that amount. And when the value is given, that's usually given by the private equity fund. So now there's some conflict there of, is that truly a independent valuation of that investment in your portfolio? Not to mention what happens when we start doing things like Roth conversions or different type of IRA investments, or what happens when somebody goes and invests in a private investment that keeps them locked up for 20 years when maybe the prospectus says they're only supposed to be or their goals are a 3 to 5 year investment. That's not a guarantee, but if you're not an educated investor in that area, you don't know. I could come up with a private equity fund and call it the super high growth private equity fund, drop that in a 401k option and show you a few years of returns of 30%. And you look at that. And if I'm not a sophisticated investor, I look at it and say, well, I'm looking for high growth. And I see a fund called the super high growth fund, and it's got a 30% return. And I just go drop 100% of my money into that one. And then maybe it's not liquid for 20 years. How are we going to handle that situation with longer lockup periods and balancing giving investors the flexibility to invest in whatever they want within that 401k, giving them that financial risk, but also balancing the complexity that comes with some of these more advanced investments that are going to be given? So we have these issues of classic behavioral traps, both on the fear and greed side and also on the 401k specific side. There's been studies that show that people invest their 401ks based on the name of the funds. No one ever reads the prospectus that's out there. So they just go through and they look and say, that sounds like a good fund. That one sounds like a good fund. And they go throw 10% here, 20% here, 30% here, 40% here, and they've allocated their portfolio. Or they'll use what's known as the naive approach, where they'll just go and say, well, there's 10 funds in my 401k, so I'm just going to throw 10% into every single one of them, which makes absolutely no sense whatsoever. Can you imagine if somebody's having that much difficulty allocating a 401k to index funds and traditional mutual funds? What happens when you start throwing private market investments in there? There's not going to be enough asterisks that you can put on top of the returns to be able to educate somebody on all the different types of liquidity risks and counterparty risks and overall risk of a lot of these investments. So I'd be very hesitant to throw this type of investment in a 401k. I think it's a great opportunity for, if you have your 401k set up in your traditional, what I've always called kind of the boring portfolio, set your 401k up in the boring portfolio. If you have excess funds outside of the 401k in a brokerage account that you want to go allocate to private equity, maybe that's a better place, especially when we look at the overall market and the overall market participants in the country. If these scenarios sound like you, that's exactly the kind of planning work we do every day at Scholar Advising. Visit scholaradvising.com to see how we help families bring clarity to complex financial decisions. And for today's From the Field conversation, we explore how real estate owners can use 1031 exchanges to defer taxes and reposition their portfolios for the next stage of growth. Today, we're joined by Julie Baird, president of First American Exchange Company, one of the nation's leading qualified intermediaries for 1031 exchanges. Julie started her career as a real estate attorney and now leads a team that handles some of the most complex exchange structures. Julie, it's great to have you join us today. Maybe give us a little bit of background of how you got into the 1031 world and what that means.
Yeah, absolutely. And thank you for the opportunity. It's such a thrill to be here, and I'm really honored and excited about the conversation. So as you mentioned, I'm the president of First American Exchange Company. I'm a real estate attorney by training. So I started in private practice in San Francisco and did a whole bunch of different types of law, did some litigation, did some bankruptcy, and then found my way into real estate transactional work, which I really love and I think dovetails nicely into the work I do now. Real estate transactions are really a puzzle, right? You've got a purchase and sale agreement, maybe some financing, maybe a lease or conservation easement. And there's all these different pieces to the puzzle that you want to put together to make a transaction work. And a 1031 exchange is just another tool in your investor's toolbox. So what a 1031 exchange provides is that an investor can defer the payment of capital gains tax that would have otherwise been due on a sale if they instead trade into like-kind property. So as long as that real estate is being used for investment or business use, a 1031 exchange can be a tool as part of the toolbox to put the transaction together. So it's really fun to have that kind of real estate law background to come in. And now we've got this other tool with the 1031 exchange to help investors make their next real estate investment and their next step in building their wealth or planning their business or doing what's right for their estate planning.
Whenever we have clients going through 1031 exchange, or at least thinking about that, they get nervous to the timelines associated with it and everything else. What are the big pitfalls that you see, the common ones that show up that end up derailing this plan? And being able to delay taxes is a great option.
Yeah, no doubt. And it's such a great question. And your point about understanding the rules is so important. One of the big things that we do as a qualified intermediary is education for exactly this reason. And it can seem complicated if you're not doing these transactions every day. So there's a couple of critical timelines. The first is the identification timeline, and that is really the most immediate and sometimes can be the biggest pitfall if folks aren't really prepared. So from the date of the sale transaction, you have 45 days to identify your potential replacement properties. And it's going to be in writing. You have to have a clear identification. So an unambiguous description is how it's said in the tax code. So you can't just say, gosh, I want to buy a duplex in Manhattan. You actually have to have a street address or a legal description. And there's a variety of ways that you can identify multiple properties. The typical way that people identify is 3 potential replacement properties, and then you don't have to worry about their values or anything like that. So that gives you these 3 options for your potential purchases. If you want to identify more than 3 properties, you can. You just really want to work with your tax advisor and your qualified intermediary because there's some additional rules that can add some complication to that. But once those properties are identified within that 45 days, the next timeline you need to worry about is actually completing the exchange transaction. And you have 180 days total, including that first 45 days, in order to complete the transaction. But gosh, that 45 days goes fast, especially in the market that we're seeing now where maybe supply is a little bit more limited or there's financing challenges. So we are seeing investors really start very early trying to figure out geographically where they want to go, what type of asset they want to trade into, so that once they sell, they've kind of got a narrow pool of potential replacement properties they're looking to identify.
Does it have to be a one-to-one scenario? I know a common scenario, especially on retirement plan, somebody says, I built up this portfolio of 5 to 10 properties and I've been managing them for all these years. They just wrap all those up, sell them all, and then go buy one large commercial property or something that's a lot easier for them to manage?
Yeah, great question. And absolutely can. And it works the other way too. If you've got one large asset and you want to diversify into several, it does not have to be one-to-one. What you're looking at is your exchange value in total. So if you have a portfolio of assets that you're going to sell at the same time, and maybe they're all worth, 500, 700,000, but the total value is 5 million of all of those assets, then your replacement value that you're going to trade into has to be that 5 million or above. So it's more the total value versus the number of assets involved in the trade. Does that make sense?
Yeah, absolutely. I'm sure that gets fun trying to figure out when the 45 days starts and everything.
That's right. You got to be a master Excel spreadsheet to track those timelines and make sure you're complying with all of them for each asset, but it definitely can work and it's a good tool for that.
A couple of the other ones, do we have these reverse or build to suit exchanges? When do those make sense? What should investors watch out for?
Yeah, absolutely. So I'll give you a little bit of background about what a reverse exchange is, because I think there might be a little bit of maybe lack of information about it because it's not utilized as often, but a reverse exchange can be a really fantastic tool. And we'll talk about a couple scenarios where that type of structure or a build to suit structure really makes sense. But what a reverse exchange is really is it's a tool that allows an investor to buy their replacement property before they want to or before they're able to sell their relinquished property for some reason. And what happens is if the investor gets on title to both properties, both the replacement and the relinquished property at the same time, they've lost the ability to trade into that property. So what needs to happen is that a QI typically needs to create an entity that will close on one of those properties and take title to it for a period of time on behalf of the taxpayer. So the typical way we see it is that the QI, the qualified intermediary, will create an accommodation title holding entity. It's an LLC, and we will take title to the replacement property instead of the investor. And then when the investor is ready or able to sell their relinquished property, they sell that, and then they buy the replacement property from us. Sounds pretty simple. There's multiple timelines involved, as you would imagine. So once the EAT or that accommodation title holding entity takes title, the whole transaction has to be completed within 180 days. So the EAT can only sit on that property for 180 days. Usually that's okay because the investor already knows what they're going to sell. So they've got 45 days to identify what they're going to sell and then trade into that replacement property that the EAT is holding title to. So there's the timelines. They're a bit more expensive because there's multiple closings. And then the thing to remember that I think a lot of people don't immediately think about with the reverse exchange is that the investor doesn't have the cash proceeds yet from their sale because the sale property hasn't closed. So they need to have cash on hand or a cooperative lender perhaps to help make the financing work because the QI is not going to put money into the deal to buy the property. The investor loans us the money to do that.
So it truly is more of a holding scenario. Their qualified intermediary is not putting up the money or putting up the risk to hold that property for a maybe purchase later on down the road. It's got to be purchased. It's just whether or not it's going to go through the actual 1031.
Yeah, that's exactly right. That's exactly right. There are non-safe harbor parking transactions that allow for more time, much more complicated and sophisticated and work in some situations. But by and large, the revenue procedure that spells out the sort of safe harbor procedure is what's used for reverse exchanges. And you had asked at the beginning is when might this be a good tool? And it actually, this environment that we've been in the last couple of years, we've seen a lot more reverse exchanges because of this shortage of inventory or just the supply on the market has been less and financing has been difficult. So investors that are able to use a reverse exchange proactively have been doing so. And what that allows them is to go out and find that perfect replacement property. They're not bound yet by any of the time constraints. They go out and figure out exactly what they want to buy. They engage the qualified intermediary. The EAT takes title to that property. Now they've secured that perfect replacement property and they can go ahead and sell their sale property and trade into that asset. And it just gives them a little bit more flexibility and control in this type of market.
How do you see these 1031 exchanges coming into play when it comes to estate planning, whether it's step up at basis or trust types of scenarios? Do you see a lot of that? Is that pretty common?
We do, absolutely. And just like any business or family, all of the unique circumstances are going to be very different. So working with estate planning attorneys and tax advisors are really critically important. With families, we see a couple different scenarios. Sometimes the family may know that the heirs aren't going to want to be actively involved with property management. So using a 1031 to trade into an asset that may have less management responsibility or maybe more easily divisible among multiple heirs. So things like a Delaware statutory trust or DST might be a really good option in those cases. And then you mentioned the step up in basis, which is exactly right. So investors that have been holding and maybe trading property over their lifetime may have a ton of built up gain because that original cost basis starts with the first investment property. So they may be doing 1031 exchanges, diversifying their portfolio, getting different kinds of assets. And now they've got a bunch of built up gain because of that original low cost basis. With the step up in basis rules that currently still exist in the tax code, upon death of the owner, the heirs that are the beneficiaries of that property upon death get a step up in that cost basis. So in essence, all of that gain is wiped out at the time of death. So it's good to know that. So as investors are planning for their estate planning, they understand the consequences at the time of death. And something to really think about, and I think for investors to be aware of as they're working through this, is they want to make sure the ownership, the way that they're holding property, is in such a way that they will get the benefit of that step up in basis at the time of, rather than maybe changing ownership to an LLC that's not disregarded or something like that that may inadvertently take them outside of the benefit of the step up in basis, if that makes sense.
I'm glad you brought that up because I think it's really easy to look at this as a one transaction scenario of I have the gain on this one property, so I'm going to do a 1031 for the other. But it's easy to overlook that if this compounds over time, you could do a lifetime of real estate gains that potentially could all receive a step up.
Yeah, that's right.
If it's done correctly.
Yep, correctly, exactly right. And there's a phrase sometimes tossed around in the industry, swap till you drop. And it's the shorthand vernacular of, hey, continuing to do these exchanges and then at your time of death, your heirs really get the benefit of that. I'm not sure planning for your death is the great long-term strategy, but it's a tool and it's good to know how these different pieces work together.
If somebody's looking at a 1031 saying, well, does it make sense? Does not make sense? Do you have an example of a situation you worked on where it worked out really well that you look to and see that one? That's how it works. This is how good it can be.
Yeah, absolutely. I have one that comes right to the top of mind. And it's been fun. We've had a couple of really, really good transactions the last couple of months. But this one I'm thinking about was a reverse build to suit. So we talked a little bit about these parking transactions and the EAT taking title to the replacement property. There's something called a build to suit or construction exchange Same type of structure with the added benefit of while that EAT entity is entitled to the replacement property, the taxpayer can actually use some of their exchange funds to do improvements. So in this particular situation, we had a family office client, and they were going to buy a new logistics park for their business, and they were going to sell a legacy retail strip center. And so we did the reverse parking transaction. They took title to that future replacement property. They had some time to do the improvements to really build out exactly what they needed for their business. Then they sold that legacy strip center. They traded in and moved the business into the new replacement property, full deferral, increase in value in the replacement property. And really the benefit of that structure allowed them to have a lot less disruption within their business. They really had this continuity of business, which it played out beautifully.
Very cool. You had mentioned that the reverse exchanges are becoming more common. If you had to wrap up all the things you're seeing right now, what are the big trends? What should people be watching out for in the current landscape?
I think reverse exchanges, for sure, they're going to continue to be a really valuable tool as the market is improving and we are seeing more volume, but I think it's still more limited on the inventory side. So the reverse exchange, using that proactively as a tool. We are seeing people use the Delaware Statutory Trust. That's the more passive syndicated investment option for replacement property, more as people become familiar with that type of asset. And we see more sponsors across the country. That was a tool that was sort of born and raised in California, if you will, but now it has spread certainly across the country. And there are some very good reputable sponsors, and people are becoming more aware of that as an option. And then I would say the other couple of trends that are a little bit related are disaster extensions. So when there is a kind of a catastrophic weather event, typically like a hurricane or a wildfire or something like that, the IRS will issue a notice about the extension of timelines for certain tax deadlines, usually tax filing deadlines. If in the notice, the IRS specifies exchanges, 1031 deadlines get extended as well. So not that this is a proactive strategy necessarily, but because of maybe the more frequent weather events that we are seeing, that is becoming more common for people to be impacted in some way, either in the property they're selling or where they're looking to buy. And so being aware that these notices get issued and it may provide more time to find other options in those events, something we're seeing more frequently. And then last, I would say, is sort of this geographic migration from maybe high tax areas in California, New York, moving to more tax-friendly states, maybe Sunbelt states, things like that. But we're also seeing some, because of these weather events and challenges with things like insurance, for example, folks are moving away from some of those geographic locations into other more weather-stable areas that just make a little more sense from a cost perspective.
Thank you so much for coming on today. I learned a lot, and our listeners will as well, on something that's such an interesting topic on the real estate side. So thank you so much for sharing that expertise with us.
Well, I always appreciate the opportunity. It's such a narrow slice of the tax code, but it can be such a powerful tool in the right circumstances. And so really making sure folks know it exists and then understand that there may be some complications related to the rules, but getting an expert to help you navigate the process is really key. And it can be just such a great way to build wealth, plan for your estate planning, as we talked about, and really make good choices for your business in a way that's deferring taxes in the long run. It's an honor to be able to talk about it and to be able to share a little bit of knowledge here.
That's our show. Thanks for listening, and we'll see you next week.
The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.